Hey folks, welcome to a product review at Finominal. Today we're going to analyze Blackstone's alternative multi-strategy fund, which trades on the ticker BXMIX. Now, the fund is a multi-strategy fund in the sense that it allocates capital to more than 20 sub-advisors, which are primarily hedge funds, private credit, and kind of like alternative asset managers. And BXMIX manages around $4 billion of assets and is marketed as per its name as an alternative strategy, which should be used to diversify traditional portfolios. So let's investigate that. And we're going to kick off with a benchmarking analysis. Having said that, we already know this is an alternative fund. So kind of like traditional benchmarks don't make sense. We do see that as a suggested benchmark, we have the S&P target risk conservative index, which is an equity bond index. But if you look at that from an R-squared perspective, it's only 0.4, so that is not that representative. Now let's still have a quick look in terms of how the performance of BXMIX would stack up versus this index. And what you can see over here is the performance since 2014. So we have about 10 years of track record. You can see that, COVID was not very kind to alternative strategies, it seems. You can see some difference performance right over here that S&P target stock declined faster, which is 2022 when equities and bonds both declined. But broadly speaking, there's a lot of overlap, which does kind of indicate that perhaps this fund from Blackstone is not as alternative as its name suggests. Now, what we can do simple returns-based factor exposure analysis. In this case, I'm going to take the S&P 500 for the equities exposure. And what we can see over here is the exposure to asset classes over time. And we do see actually that there is a low but consistent positive exposure to equities, which is, not that desirable because it's an alternative. It's an uncorrelated, effectively. We can also see, right, that the exposure to other asset classes like bonds has been time varying across the last 10 years. And there's been very little exposure to US dollar and commodities. So this is kind of as expected. And let's perhaps move on to the heart of the matter. Has this fund delivered diversification benefits? And what we do show here is we measure the diversification of this fund over the last 10 years. And we have something called a diversification score, where this fund ranks 55 on a scale of 0 to 100, 100 being best. And for diversifying strategies, you would expect something slightly higher than a 55, and we can reconcile that with effectively the correlation to the stock market being relatively high at 0.59 to the S&P 500. And what's kind of worse is that the upside beta to the S&P 500 is lower than the downside beta. And that simply means that you kind of make less money when equity markets go up than you lose when it's declining. Now, we can also quantify the diversification benefits, and we do that via the Sharpe ratio. So where we take an all equity portfolio of the last 10 years, because that's the track record of the fund, and we simulate if we have an all equity portfolio, like effectively the S&P 500, right? What would have happened if you add a 25% allocation to BXMIX? Now, the Sharpe ratio has increased, right, from 0.74 to 0.76. So you could argue this fund has provided diversification benefits. Having said this, this is so marginal, this is irrelevant. And you can take, I don't know, like any other fund, let's say AGG, which is a simple bond fund. And just to demonstrate the diversification benefits of this compared to BXMIX, you can see a higher diversification score already. And you can see a much more significant increase in the Sharpe ratio. So bonds would have diversified more than BXMIX. Now, it's also kind of interesting to contemplate, right, if BXMIX does not diversify that much, if it has equity exposure, occasionally bond exposure, right, if you can replicate that. And so what I've done is created a very simple portfolio of effectively just short-term treasuries, T-bills, and the S&P 500 in an 80-20 portfolio. And let's compare that to BXMIX. Because it seems to me that this alternative fund is nothing but diluted equity exposure. So here's a track record again of the last 10 years, right, of BXMIX compared to this simple portfolio, as mentioned, just T-bills and S&P 500. And you can see the correlation would be on the lower side, especially given that the Blackstone fund dropped significantly during COVID, right? Which is, by the way, exactly when you need an alternative strategy to perform, right, and provide those diversification benefits. But you can also see some resemblances. And so on this longer time frame perspective, right, you would argue, right, that this is a poor replication of this fund, but that's primarily due to, or one of the reasons, right, is why it doesn't look that good, is because of that decrease of BXMIX during the COVID crisis. If we rebalance that to 2020, then effectively we see something that looks much more similar. Correlation is still on the lower side, but you see effectively getting the same risk exposures simply as a little bit of equity and a whole lot of T-bills. And you could of course spend a lot more time on refining a replication portfolio and perhaps including credit strategies, perhaps a little bit of gold, things like that, right, to build something more close than BXMIX. But this already indicates that there is nothing unique happening within this alternative fund, and it certainly is an alternative. The other interesting aspect is about this simple replication portfolio, that it's only 2 ETFs, right? The Sharpe would have been higher with 1.56 versus 1.47 for BXMIX, and it would be a fraction of the cost, because the cost for this replication portfolio is 13 basis points versus BXMIX charges 2.47%, which is very expensive. And that kind of concludes the review of Blackstone's alternative multi-strategy fund. As mentioned, the expectation of such a fund would be that it does diversify, that it does provide something different than just equities or bonds, especially at this price tag. And it does not. You can replicate this portfolio with T-bills and equity, which would have had a higher risk-adjusted return, would have been cheaper, right? And so unfortunately, it seems like this is another alternative strategy that simply represents diluted equity exposure. Hope that helps. Have a nice day.